Now let's bring in our first guest. Joining us now, Charlie Bobrinskoy of Ariel Investments. Charlie, the market action today, tough for me to read. What's your read on where we are right now? I know you've been talking a lot about small and mid-cap value.
Yeah, I think the problem was he talked about the economy and talked about growth still being excessive or above trend line. And first of all, I think that's delusional. We've had 2% GDP growth for a number of quarters. That's not above trend line. He blames inflation on an overheated job market. We don't have an overheated job market. Wages are up barely in line with inflation. If you go for the last 2 or 3 years, they probably trailed inflation. So I think the concern is that he still is seeing an economy that's causing 3% inflation, when in fact inflation is where it is because we increased the money supply by 40%. Now the money supply is starting to come down, but effects are variable and lag, as Milton Friedman famously said, so it's going to take us a while. So I think that's the disappointment, that he just doesn't get that we are moving in the right direction.
Charlie, we want to get back to you now, not necessarily on those results, but I'm wondering, first of all, if you have anything to say about that, please do. But when you joined us in September, you thought, yes, the Fed will stop raising. That seems to be where we are right now. But also small and mid-cap value was the way to go because of valuation. Since then, I think the Russell 2000 Value Index down about 10%, steeper than the S&P 500. What do you think is going on here? And do you still think that's the way to go?
We definitely, unfortunately, it has continued to underperform. Value has underperformed growth. It is really surprising. I think a lot of value stocks are considered cyclical. And has been talk coming out of the Fed. They continue to be stubborn, that they are not happy with the slowdown in the economy. And if the Fed wants to cause a recession, they can. And a recession is always tougher on small cap value than, say, on growth. So what I said in September is still true, even more true. We have the Russell 2500 Value Index trading for less than 13 times earnings compared to the S&P at over 17. A lot of value in value right now.
Yeah, Charlie, forgive me if I'm retreading ground. The two of you have already walked here, since I'm wearing two hats covering earnings as well. But I do want to get back to the notion of the Fed, because one of the things you note in your notes is that we really need to go back to basics in terms of how we understand interest rates, and specifically the real rate, where that historically has tended to be, where we are now, and what the read-through is, not only in terms of monetary policy on the economy, but also on stocks.
Yeah, thanks, Morgan. This is very important. So Gene Fama won a Nobel Prize, and one of his most important findings was that the real rate of interest is actually very stable. And it tends to, over time, when the Fed is not influencing it, it tends to be about 1% per year. So that's the interest rate you earn on treasuries minus the inflation rate. Now, that's when the Fed is not intervening, and for the last 5 years, they have been intervening in a dramatic way. First, they took the assets at the Fed from $4 trillion up to $9 trillion, buying in $5 trillion of bonds, forcing interest rates into a negative real return. Then they reversed course and started selling assets, and they've now sold $1 trillion worth of bonds. While everybody focuses on them increasing short-term rates, it's actually just as influential that they have flooded the market with $1 trillion worth of bonds. And that is one of the main reasons why the real rate after inflation has gone up. And now, over the next 10 years, you'd probably forecast inflation to be something like 2.5%. We now have a 10-year real rate of return of 2.5%, which is way above normal. So we've got, and that has an implications for the stock market. The stock market uses interest rates to discount future cash flows back to the present. And that is one of the things putting pressure, no doubt about it, on value stocks.